Good afternoon, everybody. I'm Julianna Tatelbaum. I'm a news anchor at CNBC, and I'm very pleased to be moderating this next panel around the technology sector. To be specific, this panel is entitled Valuation Drivers and Risk Factors for Technology in 2022. We've got an excellent panel of varied voices for you. Let me introduce them. We've got Mark Hawtin, Investment Director from GAM, Hugo Scott-Gall, Partner and Portfolio Manager of a Global Leaders Fund at William Blair Investment Management, and Daniel Pinto, CEO of Stanhope Capital. So hopefully we'll have a really interesting conversation. We'll talk for about 30 minutes and then open up the floor to questions. So if you are joining us online, please get your questions ready and send them in, and we'll get to them a little bit later on. So I want to kick off the panel asking each of you what you think the one big theme is going to be, the biggest driver for the technology sector going into 2022. And Mark, we'll kick off with you.
Thanks. So for me, it's essentially a shift into the next wave of innovation. I think the last 10 years has been very much about the platform opportunity. It's the way in which connected devices in the form mainly of smartphones have allowed for the proliferation of platforms like Facebook and Google and Amazon. But I think we're heading into the next wave now, which is the connectivity of everything, the Internet of Things, as many people call it, and the way in which you have this flywheel of connectivity, data, and AI, driving sectors which have perhaps been slightly less disrupted to date. So things like industrials, healthcare, transportation, the automation of knowledge work, replacement of human labour with machine. It's those kind of areas which I think are going to be particularly disruptive over the next 10 years.
Excellent. Hugo, we'll come over to you, and for the audience, Hugo is more of a generalist, so it'll be interesting to get your take on what you think the big theme is going to be next year.
Well, disappointingly, I agree a lot with Mark. I think it's not just one theme in particular, it's more of this tech is everywhere theme that actually find me an industry that isn't being impacted by technology, either in the share of growth, share of competitive advantages, the strength of competitive advantages. So to build on what Mark said, look, it's the energy transition. The energy transition doesn't happen without technology. mRNA is stimulated by, it's simulated tech environment, computational biology, ag tech, ed tech, anything you want to add to tech is happening everywhere. So as far as we're concerned, when we think about where to look for growth, it's usually to do with either a revenue pool being redistributed or being created due to technology, or competitive advantages either being stronger or longer due to technology. So it's this idea of tech is everywhere we think was a huge theme last year, the year before, it'll be next year, the year after, and then the year after, and so on.
Daniel?
So I would say that the Metaverse is going to be the big development of 2022 and beyond. Metaverse is going to completely overhaul the world of social media, hence the fact that Facebook decided to change its name. It's not the only reason, but it was one of the reasons. Just imagine a universe where you interact with friends, people, even people you don't know, in a kind of quasi-physical setting, which is virtual. That is going to completely change the way you use social media, and it's going to completely change e-commerce. Imagine a shopping experience where you literally walk in a shop, and where you can have exactly the same kind of experience as if you were browsing and looking for something. That is going to be, in my view, the big development. Whether it happens in 2022 or 2023 on a grand scale is a different question, but I think to me that's the big development.
And to date, the technology sector has been dominated by a handful of behemoths, the FANG stocks to be precise. Do you think that the traditional FANGs are going to be the gatekeepers to the metaverse?
I think they are going to lead in terms of research. I mean, there are many startups, interestingly, that have developed technology in various sectors, again, e-commerce, etc. But clearly, the amount of money that is being spent by the FANGs is just mind-boggling. And so their capacity to come to market with a marketable product is just second to none. And so you will see the likes of Google, Facebook coming with a metaverse offering more and more. And they will keep dominating, I'm afraid.
Mark, I'm curious your take. I know you've covered the sector for a number of years, and you've watched these FANGs grow into what they are. Do you think that we will have FANGs 2.0? Do you think the current ones are going to be the ones to lead us forward? How do you see the next wave looking?
They'll clearly play a major role. I mean, Facebook is spending, as they've said in their last quarterly earnings call, $10 billion a year on their Metaverse project, in a sense. We've yet to see the output of that. So I think that clearly, with the amount of money they have to spend, they will be major players. However, there will be other companies, I think, companies that have been around really for quite a long time. So a company like Roblox, for example, which has been around for 12 years, is probably one of the clearer specialist metaverse players at the moment in the quoted market. And it's interesting, they have just begun to launch some of these virtual stores on their platform. So Gucci has a store on the Roblox platform. They've had 20 million visitors, spending a lot more time in that environment than they would spend watching a 10-second video clip on Instagram or visiting a Facebook page. And that will translate ultimately, I think, into both virtual and physical sales for those kind of companies. So there will be other players as well. But I do think the mega caps just have a huge amount of money to throw at it, so they have every chance.
Now, this panel is obviously about technology in 2022, but specifically about valuation and how that plays into the technology debate moving forward. Daniel, I want to ask you, you're very involved from the VC perspective, and we've seen competition for deals intensify with the entrance of non-traditional tech investors joining the fray. We've got the likes of SoftBank, Tiger Global, who seemingly have endless money to spend when it comes to technology deals. How has this investment landscape changed, and how has the emergence of so many investors of this kind with so much money impacted multiples and ticket size?
So I'm going to give you one number which tells part of the story. There have been about 50 IPOs in the US, technology IPOs in the US, if you include SPACs and direct listings of technology companies. Of the 50 companies that went public, more than half have lost more than 50% of their value. Only one company has lost less than 20%. So the story that it tells you is that the public market is sending a message to the private market and saying, you've gone too far. Your valuation level is not something we understand or can buy. And in my mind, going back to the issue of 2022, what you'll see in 2022 is a tale of two markets almost. The large digital players that are profitable and keep making a lot of money and are growing as well. That will be one market, and I think it will continue to thrive. And you'll have a second market, which is the companies that so far were given the benefit of the doubt, but may lose the benefit of the doubt. And in fact, you already see it in the numbers I gave you. The ripple effect it has on the private market is that it's like a domino effect. If the public market is no longer willing to take what you deliver to them, then something ought to happen in the private market, in the world of venture capital. And what will happen is that, as you pointed out, there are a few players that are on a kind of land grab mission. They want to dominate the venture world. Put it bluntly, they care more about how much they spend than at what value they spend. So it's an issue about targeting as many of the most promising companies as they can, and investing at least 200 or 300 million per company, and to do that with large numbers on a grand scale. That can only go on if the public markets are there. As you can hear, the public markets are no longer there for this kind of approach. So what you'll see is a ripple effect, which is frankly beneficial, because what you'll see is the latest rounds pre-IPOs will probably happen at more reasonable valuations. And the initial rounds, which absolutely went crazy this year. I mean, you used to see round A's of financings at 5 or 10 million. Now you see round A's of financing as 100, 200 million easily. And that tells you something about the excess. And I think that excess was detrimental. And I think that we are going to swing in a more kind of reasonable direction.
Well, Hugo, let me come on to you and take this conversation to the public market. If you have these companies coming to market at these huge valuations, how do you think about analyzing them? What's your thought process when it comes to distinguishing between companies that are overhyped versus ones that actually deserve these lofty valuations?
I guess our process really isn't any different. We're still asking the same questions, and we put valuation to one side. We try and work out what could this company be worth, and then work out what it is we're being asked to pay for it. And so I think our process doesn't really change very much from number one. We're talking about tech companies. So number one, do we understand the product? Do we understand why anyone would buy this product? If they didn't buy the product, who else would they buy it from? So we want to understand the job to be done. We want to understand by asking the company what it is they do that's hard to replicate. It's a sort of easy question. What is it you do that's hard to replicate? You'd be surprised at the range of answers you get. Why are you hard to compete with? Again, that gets a range of answers. If one of the FANGs decided they wanted to obliterate you, how would they do that? How long would that take? That's another question we ask. So we're really still asking the same kind of questions, which is, what is it you do? Do we understand the product? What do we think the addressable market is? And over time, the inflation of the use of the word TAM has been pretty remarkable. But do we understand that? Do we understand adjacency? Do we understand the optionality? So can we kind of work out with that blend of understanding growth, competitive advantage, what might be possible in terms of earnings? And I guess, yes, of course, near-term valuations as expressed by PEs might lead to optically very high numbers, but the kind of companies we're talking about here, really, you want to understand what's possible, what is the right tail of the distribution, what could they do, and then what are we paying for that? So we're really asking the question much more around, could this company grow its revenues 3x, 5x, 7x, 10x? Certainly 5 years ago, you'd feel that very few companies are priced for 10x revenue growth. Now, you definitely do see more companies where you think, okay, they maybe could grow their revenues 5 or 7x, but maybe that's where they're priced. So I think that's probably the difference, which I think chimes with what you're saying, Daniel.
Mark, what's your take on valuations at the moment, looking at in public markets, technology stocks?
Well, I think valuations had got ahead of themselves in quite a number of segments of the market. And I think from the way we look at this, the only really sensible way to go about the valuation process is to look at what is a company worth on an intrinsic basis. We spend very little time looking at sort of more traditional metrics like PE. We do DCF modeling because one of the things about the world today and many of these companies is that their revenue models are very different from the companies of the past. We're moving more towards a subscription economy. So if you're, for example, a software company, you're getting a subscription every month from your user. You're not selling one license to essentially allow that user to use your product for 3 years or more. And so that means that what tends to happen is your business grows at maybe 20 or 30% for many, many years. Salesforce has grown its revenue by between 20 and 30% for over 20 years now. That didn't happen in the past. So you need a much more intrinsic way of looking at what that can look like over the long term. But having said that, valuations had clearly moved to excess in certain parts of the market, and I think it's frankly, it's the more hawkish stance that we've seen taken by the Fed, which has just kind of alerted people to that and thinking, yep, so actually what is the right sort of discount rates we should be using in these businesses? Let's reset the risk parameters. And that's what's led to a number of these areas, whether it be SPACs or IPOs or very high growth software businesses, seeing quite significant setbacks.
And if interest rates do rise, which they are poised to do in the future, you can debate when, what does that mean for current multiples in the sector? What kind of re-rating could we expect or de-rating?
Well, I think essentially you just have to feed that potential into the discount rate that you're using for the modeling. So from our perspective, actually, it doesn't make an enormous difference because we haven't used anything like 0 or 1% as our risk-free rate. We've never gone down below 4 as a risk-free rate. So from a fundamental perspective, I don't think it makes a great deal of difference, but I think on a macro basis it will. It'll just reprice risk. So we'll see the public market valuations coming down on the back of that, and then as Daniel says, that will lead to a fall in private market valuations as well.
Daniel, I want to come back to you. You weighed in on the private market side of things, but in terms of public markets, we have seen this tug of war throughout 2021 between value and growth, and every time it looked like growth was on its way out, it seems as though investors stepped in and bought the dip. In particular in the U.S., retail investors stepped in. How do you see this tug of war playing out in 2022?
I think more selectivity. It will keep playing out because every time the market is concerned about rising interest rates, you see that investors tend to sell their tech stocks, their growth stocks, and buy into value and cyclicals. I think it's been almost too mechanical. If you look at what happened this year, it was like the pendulum swinging from one side to the other, almost systematically driven by anticipation on interest rates. And I think investors have not been selective enough. There is no reason in my view, for the FANGs to suffer from rising interest rates, because they are already so profitable that even if you think about it in terms of current value of future earnings, there is no reason for rising interest rates to bite. And frankly, if interest rates were to go from the 10-year in the US from 1.4 to 2.5 or even 3, what difference does it make? Where it's going to bite is for the companies that are not yet profitable. Where it's going to bite is for the companies where there was tolerance until recently, for companies where you could say, well, in 5 years' time, maybe it will be profitable. That tolerance will kind of dissipate. So tug of war, maybe. I think that also the investors who bought into the cyclicals and value realize that when COVID returns and airlines cannot fly, the trade was not so great. So, a lot of people bought banks, airlines, etc., in anticipation of certain movements, and they realize now that it's not a one-way street. You can lose money on these kind of trades. It's about being more selective and perhaps a bit more intelligent about, and longer term about where you want to put your money.
Hugo, I want to come to you. You talk about how you think about technology so far as it impacts lots of sectors and not necessarily as a standalone part of the market. You hear this argument a lot, talking about stocks like Tesla, that yes, its valuation looks astronomical if you think about it like an auto company, but if you start to look at it like a tech company, you can start to justify that valuation. Building on Mark's point about how so many companies now have different types of revenue streams that we haven't seen before, I'm curious how you think about that argument, looking at some of these stocks in non-tech sectors as tech stocks, and how you think about approaching companies that have these brand new types of revenues.
Yeah, look, it's a large part of our day every day doing this. So I think we're really trying to understand, is there something that any given company does that actually could be transformed by technology? We try and think very simply, hopefully not simplistically, about a product. Is it better on cost? Does it have better capability, or is it more convenient? And there are still many industries, parts of industries, where there's huge inconvenience. So we're very interested in trying to identify companies where they can transform the industry's sort of standard product by either being much cheaper, driven by technology, or oftentimes being more convenient. I think on average it takes 75 touches to open a bank account in the UK. It kind of tells you the convenience bull market is not over. So there are many things which are inconvenient, many things which we didn't even know were inconvenient. And so I think that is a big driver of how we assess products, and those changes, cost, capability, convenience, are nearly always driven by technology. But we're also thinking a lot, as I gave at the start, the examples around industrials. We're not really saying, I think, that overall we kind of see revenues growing at a 2 times clip of what they were before due to technology. We're really saying these competitive advantage periods are getting much, much longer, that if you make a widget, previously it was dumb, now it's smart, it gives off all sorts of information, the relationship between the maker and the operator, the customer, becomes symbiotic, and the switching costs go up massively, and therefore you have greater confidence for longer in the competitive advantage period. So it's still those sort of basic tenets, I think, of what happens to growth and why, what happens to competitive advantage and why, but more and more that the cause is it's due to technology. And oftentimes, I guess we're looking at things we own, companies we own, and kicking the tires, saying, actually, can they use technology to respond to disruption? And oftentimes that is more of a capital allocation question, which is actually, this company probably isn't sufficiently innovative to respond to the threats to it, but can it use the M&A channel? Can it buy in expertise in R&D to help defend itself? And I think that goes back a little bit to the sort of FANG 1.0 versus FANG 2.0, which is, if you're talking rising rate environment, if you're talking about how to defend against disruption, that is a key part of what an incumbent management team should do. Do they know how to defend? Do they know how to allocate capital to do that? Are they brave enough to really switch how they use the capital allocation channels?
Really interesting comments, Hugo. I want to shift the conversation to regional differences, and Daniel, we'll kick off with you. One of the big questions for tech founders is where to list when they're thinking of coming to market. And one of the big factors is what type of structure they may have. So I'm curious your thoughts on the dual class share structure. I know you have a lot of views on it, and there are a lot of differences between the way companies can list here and the listing rules versus the US, which of course has been the dominant area.
So in the US, most tech companies come to market with a dual share class structure that gives more power, more voting rights to the founders. And the intention behind it is that you want the company to remain entrepreneurial, led by founders, and even if you fall below the threshold of 50%, these companies want to still be led by the same teams. It's very common, no question asked almost in the US. It's like, if you go to a movie and you don't like the main actor, you just don't go to the movie, don't buy the ticket. So people buy into the IPOs in the US on the basis that if they like the team, the issue with dual share classes does not arise. In Europe, and particularly in London, there is almost the opposite attitude, which is if you come to the market with a dual share class, giving undue powers to the founders, you'll be mistreated by the market. And the examples are well known. Deliveroo was massacred by the market post-IPO. The Hut Group, it's almost, it's almost a killing game. Almost every week you have an article about the Hut Group in the main national newspapers to explain that the founder is not someone you should be investing with. The consequence is very sad. It's that the most promising tech companies in London, in the UK in general, are disincentivized to list in London. And they go to the US. So to be clear, you can list in London with dual share classes, but you have a standard listing. You don't have the premium listing, which would enable a whole group of investors, including indices, to buy into your stock. So it deprives you, if you will, of the kind of normal treatment of a stock that can be bought by indices, etc. And I think it hurts us in the end. And Lord Hill, as you know, wrote a report recommending the adoption of enabling companies with dual share classes to have premium listings. The government is backing it. And the people who are resisting, sadly and oddly, are the investment management giants in the UK. I won't name names, but you know who I'm talking about. They came out very strongly against it. It's unfortunate.
Mark, surely you've had experience as an investor in some companies with dual share structures. What's your take?
I concur a lot with Daniel's views on this. I think also in Europe and in the UK, there's a lot more focus on corporate governance and dual share classes just being essentially wrong. But I think one needs to be practical and commercial about it. I think there are other issues, frankly, causing problems for listings in the UK and in Europe. It's much harder to get startup capital. European investors in innovative growth companies tend to want to see business plans with very clear routes to profitability. There's much less of an interest in backing a concept. I think in some cases, the UK particularly, the UK equity market is highly illiquid. There are companies with market capitalizations of $30, $40 billion that trade less shares a day than US companies with $1 billion market cap. So there are a whole series of issues within Europe and within the UK. And until those are changed, it's going to be very difficult. I mean, Zendesk is a great example. That was a Danish company. Perhaps the best decision they took from a management team point of view was at a very early stage to move from Denmark to Silicon Valley. Mm-hmm. They were able to find the capital, they were able to find the clients, they were able to manage the business as they wanted to, and now it's a almost $100 billion company. Now that could have been sitting in Europe in the right environment and would have been a leader in Europe. Mm. So there are a whole series of issues, and it's a serious problem.
Do you think there's any chance that we will get champions in Europe?
Not unless these things change.
Mm. Hugo, what's your take? I mean, clearly European leaders talk about wanting to create tech champions. You've got President Macron constantly talking about this desire, but it hasn't happened yet. And just today, the Italian antitrust regulator slapped Amazon with a more than €1 billion fine for alleged abuse of market dominance. So investors talking about, again, that as a deterrent for companies building and growing themselves here.
Well, we're global investors, and we see all around the world increasingly local innovation, whether you're looking at LATAM, at delivery businesses, whether you're looking in Southeast Asia. So you see it all around the world, but for sure, I think a good lead indicator for any economic region, any country is the sort of the reinvestment rate, of which R&D is a big part. So if you're seeing successful R&D, what does it need? It needs dollars, and it needs human capital, and it needs data, and it needs the other things around it. But if you starve parts of the world of capital, of human capital, you will see people move. And if you look at sort of people flows, obviously they've been heavily disrupted in the last couple of years, but the US has seen consistently, I think 40% of people in the world who say they want to emigrate want to go to the US, and that hasn't changed. So I think any part of the world, any region, country that makes itself unfriendly or inimical to innovation is asking for trouble.
Daniel, I think in the audience we've got a number of tech founders, tech creators who would be interested to know what qualities you think a company needs to exhibit to get a decent valuation at IPO.
I think that it's the clarity of purpose and the capacity to explain to the market when you're going to become profitable in a credible way. Not just a hopeful way, but a credible way. And I think the founders who succeed most, the tech founders who succeed most, are the ones who marry the vision to create a very interesting group. That's the primary quality. But the second one is the capacity to communicate why they are on something very special and when it will become profitable. I have the good fortune of sitting on the board of S4 Capital, which is the digital advertising group founded by Martin Saul once he left WPP, and we became the second largest shareholder of the company. That company, in the space of 3 years, became a leader in its field, digital advertising, with a market cap of £4 billion, based out of London, but a global business. The reason why I'm mentioning the example is that in spite of everything we said about the obstacles that are put in the way of entrepreneurs and promising companies in Europe, some entrepreneurs, if they think global, can actually make it and make it on a grand scale. And again, in the case of S4, the reason why it has made it to such an extent is that almost from day one it was profitable. And obviously the company grew through acquisitions, but the companies that were acquired were profitable, not only fast growing, but profitable. And I think that it's one example. There are many others. So although we obviously want the European markets and the UK market to be more entrepreneur friendly, there are ways to succeed in spite of, if you will. It's sad that we should say in spite of and not thanks to, but there are ways of succeeding.
Well, have a couple more minutes with the panel speaking up here, but just want to remind you that we'll go to questions in just a couple of minutes, so hopefully you've got some brewing. Mark, when you think about the risks to the technology outlook for 2022, what is top of mind for you?
I think it's going to be most likely macro risk. I don't see anything. I was in Silicon Valley 2 weeks ago for my first field trip for 2 years, which was really nice. There's absolutely no lack of buzz. There is no view that things are in any way slowing down. In fact, if anything, they're speeding up. So the risk, I think, really will come from the macro side. It'll come from concern about where interest rates are going to, the pace at which money stops being pumped into the market. So I think it's macro risk, and that's incredibly hard to formulate a view on, to be honest. There's absolutely nothing in the fundamentals of the businesses, to my mind, that's going to cause a major issue.
And Hugo, do you want to weigh in?
I agree with all that. I guess to derail technology would maybe mean some big change in regulation and some part of the world, but would that really derail the underlying rate of innovation? I don't think so. So I completely agree with what Mark says. The ingredients, I think, are just unstoppable.
And lastly, Daniel,
on which aspect? I'm sorry.
On the risks to the outlook for technology in 2022, if something is going to derail the sector.
No, I mean, you'll have obviously attempts by regulators and antitrust organizations to put an end to the dominance of a few players. That will be probably a theme for 2022. I don't think it will necessarily derail the sector, but it will be a concern. If you look at all the issues related to privacy, it is a big issue. Regulators are rightfully concerned about it. Companies are trying to address the concerns and are changing the way they are doing things. You would be aware that Google announced 2 years ago that it would be the end of the cookies, the thing that follows you wherever you go on the internet. They haven't put an end to it yet. I'm not saying they should, but I'm telling you, it's harder to do. So all these issues of privacy will be at the forefront of everyone's concerns in 2022, will not derail the growth of the sector, but might actually force people to pivot occasionally.
All right, with that, I will open it up to questions. So please raise your hand if you're in the room, and if you are watching online, you can write in your questions and we will get to them here. So, yeah, go ahead.
Thanks very much, everyone. So members of the panel, Mark, Daniel, variously talked about profitability, and we sometimes think about the trade-off between growth and profitability. And it feels like in 2021, we've seen a number of the larger listed tech businesses, move in that spectrum towards profitability rather than growth. So I think the example I'm thinking of is Uber, who it feels like this kind of aggressive expansion strategy by pushing out very low margin business may have come to an end. Firstly, would you agree with that? And secondly, do you see that as an increasing trend that these businesses are reaching maturity and striving for profitability over growth? And do you think that investors will reward them for doing that?
Maybe I'll go first. So I think yes, but Uber is a really good case point because, to my mind, the Uber business model for a very long period of time was about sucking in enormous amounts of very cheap and freely available capital and essentially using it to subsidize the network, to pay the drivers, to allow the consumers to pay very little for their rides, and therefore to build the network. And therefore it was a completely broken business model in that respect. So the one thing that just certainly has happened in the relatively recent past is that the market has become much tighter on that kind of excess. But more broadly, I think we'll just be very measured, very measured approach. As long as it's possible to see the path to profitability and that it's built around the sensible business plan that investors can put their signature to, in a sense, then I don't think it really matters too much whether you remain approximately break even. You don't want to be hugely loss making, but I think you can afford to drive growth because a lot of what's happening is about the network effect. You want to be the network winner. Network winner takes most in this economy, and therefore you do want to grow your business. So I think there will still be a need to balance it appropriately, and growth is still very important.
Daniel, do you want to weigh in?
Yeah, I would just add, I completely agree. What I would add is that it depends on the sectors. We talk about tech as if it was one thing. In the more traditional or mature sectors in tech, like e-commerce, very little tolerance for losses. In other words, you need to make money more quickly because it's become a mature business. You go to the other end of the spectrum, which is AI, and all the the companies doing AI. Investors are smart enough to understand it will take longer for the business model to yield profits. So the question is how long, but there is more tolerance. So it's all about where you are in the kind of development cycle of the business and the sector in which the business is active.
All right. Next question. Yep, over here.
Hi, Ian Day from Edelman. Just a quick question. Daniel, you mentioned the SPAC market and the aftermarket and some of those tech stocks. I'm just keen to get the view of the panel. Do we think that's a reflection of the technology that's listed, or is that to do with the technicals in the SPAC market and the issue that there's been with the SEC changing the rules on warrants and so on? Is that a technical thing in the view of the panel, or is that a reflection on those companies per se?
For SPACs specifically?
Yeah, those SPAC stocks.
So, if I may start, the issue with SPACs is that it is, to a degree, a flawed model. It is a model where you raise money without knowing if the money will be there when you need it. Because what you do, as you know, is that you raise money from investors who have a right to pull out at the last minute whilst making money on the warrants. So you arrive at the point after a year where you have found the target you wanted to acquire, and then for some reason, half of the money you raised disappears, people cash in on the profits of the warrants, end of the story, and then your only second solution is to hope that the pipe, the private equity vehicle that has been raised, will cover the amount you need to actually make the acquisition. It's a model that I'm not saying we shouldn't have SPACs. We should have SPACs with different rules. It's a very good idea to enable investors to have access to interesting companies directly in the public realm without going through an IPO. The principle was sound. The method is not sound. And I think the regulators have to change the rules. The money should stay, et cetera, et cetera. So in my mind, it's a question of maturity. I hope that the SPAC market will get to a point where it is deemed to be more mature. I hope as well that the incentives will be more aligned. As you know, the promoters of SPACs are almost guaranteed to make 30%, to receive 20, 30, 40% of the value, 30% of the value of the company, not the profits, the value of the company that they acquired, even if 6 months later the stock price has collapsed. That is not right. In private equity, you receive 20% performance fees once you have demonstrated that the profits were there for investors as well. So all of this has to be fixed.
Got. Yep, over here.
Thank you. We've had a few questions online. The first one, I think, goes back to Daniel's earlier point around a tale of two markets. We've had one question around whether the post-IPO drop in share price could perhaps be a reflection of illiquid listings and a kind of lack of stock for sale rather than public markets withdrawing. And separate to that, we've also had a few questions around the number, or indeed the type of IPOs that you have all participated in recently, and if you haven't got involved, what are the reasons for that?
So on the first question, I don't think it's an issue of the size of the float, if that's the question, because the rule today is that you have to have a substantial float in order to go public. I think it's about 25%, depends where, but you cannot get away by floating 5 or 10% of your stock. You just couldn't float. You could not make your company public. So I think it's more the other issues. And plus the size, the market cap of the companies that went public is substantial. So it's neither the size of the float nor the size of the companies that accounts for the decline in prices. It is about the valuation at which the company goes public, which sometimes is so toppy that it's bound to go through a correction. And I think, frankly, investment banks bear responsibilities. You have different ways of going public. Direct listings are becoming more popular. They are the democratic way of going public because it's the company directly in front of potential investors in a kind of auction. When a bank is appointed, which is still 95 or 98% of the cases when an IPO happens, they are supposed to come up with the right value. And sadly, instead of doing the job of telling management and shareholders, this is the fair value, they start from the assumption that the last round pre-IPO was a flaw. Then there has to be a premium to make everyone happy. And you hope that the retail investors will take it. Well, guess what? They take it and then they throw it away. And that's how the stock price collapses.
Hugo, when we were chatting before the panel, you made an interesting comment that you say no more often than you say yes. So talk us through the way you've approached IPOs recently.
Sure. I mean, that's just sort of math when there are more IPOs. But yeah, look, we as Daniel said, there's a lot of hullabaloo and noise around IPOs, but for us, that's kind of neither here nor there. We're still, as I said earlier, following the same process. And if we don't understand, or if we're not sure, or if we need to know more, if we feel we need to meet the management team more than just the once, or if the management team kind of gave us answers we weren't quite comfortable, we're very happy with saying, actually, we will pass. And I suppose, of course, we are trying to work out for ourselves what something might be worth. So we do our own work around valuation, a similar way to how Mark outlined it. We'll get to our own estimates, and if we find that actually consistently, even if we do understand the product, the addressable market, the competitive advantage, the possible earnings power, and if we understand all of that and we still can't get there on valuation, then we're happy to say no. We feel absolutely no kind of, dare I say it, FOMO.
Mark?
Yeah, I mean, I'd say, from my perspective, I mean, we've definitely been saying no a lot more than yes recently, and valuation is a key part of that. I think there are only ever two reasons to invest in an IPO. The first is that you think that the IPO is coming at such an amazing price that you'd be foolish not to be getting involved in it, because there's a gap risk implicit. When you invest in an IPO, you don't know where the first trading price is going to be, so you're taking a risk. So you've got to really feel that the valuation works for you. Or the second feature is perhaps liquidity. If it's a company that you want to own a lot of stock and you don't think you'll be able to get that stock easily in the secondary market, then that would be another reason. But aside from that, there is no reason. And what's been happening recently is that valuations have been way too high. So actually, those ideas drop away, and you tend, therefore, as a result, not to get involved. The other point that's worth making is that at the end of the day, the companies that IPO are paid by the banks. They're not paid by the investors. And I've seen it from the company side. I've sat on a board and watched the banks coming in to pitch. And they all pitch higher than the last one in the room because they want the business. So it's just not stacked up in favor of the investor either in that respect.
Well, I'm afraid that is all we have time for. Hopefully you found the panel interesting. I certainly did enjoy listening to the three of you. This has been Mark Hawtin from GAM, Hugo Scott-Gall from William Blair Investment Management, and Daniel Pinto from Stanhope Capital. So thank you.